Welcome back to the deep dive. We're diving right into the stack of articles and notes you sent over. Really appreciate you sharing all this with us.
Absolutely. Our job here is to sort of act as your guides, wade through this material, pull out the important bits, the surprising facts, and give you those key insights, make you feel really informed.
And it's quite a mix you sent this time. We're looking at, well, everything from major policy changes in Washington, think tax cuts, safety net adjustments,
Big stuff.
yeah, right, all the way to AI safety concerns, why people are using buy now, pay later for, well, groceries of all things, and
hmm
even what these tariff threats might mean for, say, the price of your next iPhone.
It really is a snapshot of, the big economic, tech, and political currents right now.
Hmm.
So we'll dig into these specific areas from your sources, maybe start with those policy moves, market reactions,
Sounds good.
then weave through the tech side, personal finance, what's happening with labor.
Perfect. This is your deep dive based on your material. So let's start then with Capitol Hill. What's this big bill the sources mention?
Okay, right. The sources focus on this House-passed bill, nicknamed the One Big Beautiful Bill Act. The key thing to grasp is its dual nature. It bundles tax cuts with spending increases.
Right, spending increases. And the notes specifically mention defense spending getting a boost.
Exactly. Now, economically, the analysis suggests, well, maybe a short-term bump.
Yeah.
But the bigger picture, probably a higher fiscal deficit down the line. Less money coming in, more going out. Simple as that.
Makes sense. But those tax cuts, where do the sources say the benefits mostly go?
Yeah, this is where it gets interesting. The analyses you shared show the bulk of the benefits heading towards wealthier households
Yeah.
through things like cuts related to business income, a much higher cap on the SALT deduction.
State and local taxes.
Right, and changes to the estate tax, income tax rates, opportunity zones, those kinds of things.
And those CBO and Yell numbers you flagged, they seem pretty stark.
They really paint a picture. According to the CBO, for the bottom 10% of households, income could actually um, fall by 2% by 2027, maybe 4% by 2033.
Fall.
Yeah. Contrast that with the top 10%. They're projected to see incomes go up 4% in 2027, 2% by 2033. And that Yale analysis for 2027, bottom 20% potentially down $800 on average, top 20% maybe up $9,700, the top 1% potentially gaining $63,000.
That's a significant gap opening up, though you also noted the sources say some high earners might actually pay a bit more.
That's a fair point from the sources, yeah. It's not universally beneficial for all high earners due to some deduction limits. Now, the flip side, how are these tax cuts, estimated over $4 trillion, paid for?
Okay.
Through cuts to social safety net programs, specifically Medicaid and SNAP. And that's the explicit reason the analyses show lower earners generally worse off. The program cuts hit them harder than any small tax benefit they might see.
And the sources called these cuts historic. What kind of scale are we talking?
We're talking roughly $700 billion cut from Medicaid and about $300 billion from SNA through 2034. And yes, the sources do frame these as the largest proposed cuts ever for these programs.
Okay, so how do they actually make those cuts happen? What's the mechanism?
It's mainly through new or expanded work requirements.
Hmm?
For Medicaid, this would hit people covered under the ACA expansion. They need to do like 80 hours a month of work or other qualifying activities, unless they're exempt, of course.
And that implementation date got moved up, didn't it?
It did, yeah,
Yeah.
accelerated. It has to be implemented by the end of 2026, but states could actually start sooner.
Which has practical consequences, I imagine. The sources mentioned that.
Absolutely. It really shrinks the timeline for things like public comments on the rules and for states to actually get their systems ready, tell people what's happening, big lift. Plus, for those ACA adults, states would have to check eligibility every 6 months, not 12, like now.
Mm,
One expert quoted put it pretty bluntly, bottom line is a lot of people will lose benefits.
that's direct. And SNAP, similar story.
Yeah, SNTP work requirements get expanded too. Right now, it's mostly for childless adults under 55 who can work. This bill takes it up to age 64 and also applies it to households with children, unless the kids are under 7. States would also have less wiggle room on waivers, and because of federal funding cuts in the bill, states would have to chip in more of their own money.
Got it. Okay, let's pivot a bit from domestic policy to international trade. Your sources covered recent tariff moves and threats too.
Right. So first, the China tariffs.
Yeah.
The federal judge just ruled the administration did act lawfully using the IEPA Act. Now, the interpretation was pretty broad, basically saying tariffs could be used for more than just revenue, like stopping drug flow or fixing trade deficits.
So legally, that's a short-term win for the administration, maybe moves the cases to a specific trade court?
It looks like it. But you know that there's a quote from an economist raising concerns, saying this broad interpretation, if courts don't define what a national emergency really is under this law, could give presidents almost unchecked power over markets. Something to watch.
And then there was action on the EU front as well.
Yes, a pretty significant threat of a 50% tariff on EU goods, maybe starting June 1st.
Yeah.
The reason given, talks were going nowhere. And the sources noted this actually caused some ripples, stock market dips, some cargo ships apparently canceling trips to the U.S.
Wow. Then there's a really specific one targeting, well, the iPhone.
Yeah, this one really stood out. A threat of a 25% tariff on imported iPhones unless they're made in the U.S. The language was very specific, not India or anyplace else. Apparently, this came after a meeting with Tim Cook from Apple.
Which is interesting because Apple's already moving some production to India, right? Partly because of existing tariffs on Chinese goods.
Exactly. They're trying to diversify away from China already. So this threat, does it mean iPhones made in the USA are coming soon?
What do the analysts think?
The analysts quoted in your sources, pretty skeptical. They think it's much more likely Apple would just, well, eat the cost of a 25% tariff. Or, more likely, pass it on, raise iPhone prices by maybe $100 to $300.
Rather than actually move production here, why is that seen as so unlikely?
It just comes down to the massive complexity, the time involved, building whole new supply chains, factories in the U.S. That takes years. And the sources mentioned Foxconn, a huge Apple partner, is already building a big new $1.5 billion factory in India. Potentially for iPhones. So the trend seems to be diversification, yes, but maybe not necessarily to the U.S. on a large scale like that.
Got it. Any other quick administration actions mentioned?
Yeah, just a couple of quick ones. A judge blocked those DOGE plans for federal worker cuts, though that's being appealed. And the Supreme Court hinted Fed members might have protections against being fired by a president.
And something about nuclear energy, overhauling the NRC.
Right. Orders aimed at speeding up approvals for new nuclear reactors, mentioning streamlining the NRC, maybe letting DOE and defense build reactors on federal land.
For what purpose?
For defense sites, yes, but also, interestingly, to power AI data centers.
Yeah.
And also boosting U.S. uranium mining.
Okay, that link, AI driving nuclear investment, that's fascinating. Let's really dig into the AI landscape now because your sources hit on safety quite a bit.
They really did. A big point was Anthropic activating what they call AI Safety Level 3, ASL 3, for their Claude Opus 4 model. Not Sonnet 4, just Opus 4.
And this was a precaution to limit misuse for things like developing dangerous weapons, CBRN.
Exactly. Chemical, biological, radiological, nuclear. And interestingly, they did it before they were certain the model had actually crossed the technical line requiring that level of control.
So being proactive.
Seems like it. Their chief scientist, Jared Kaplan, is quoted talking about the risk with powerful models, how they could go off the rails as tasks get more complex.
And there are broader concerns from experts that companies might be prioritizing profits over safety, putting speed first.
That's definitely a theme in the sources. The worry is this race makes models potentially more likely to be good at bad stuff, as one person put it. Easier to trick, easier to tamper with.
The sources mentioned that Grok example.
Yeah, Elon Musk's chatbot. It had that weird incident, fixating on something totally unrelated. The company blamed an unauthorized modification. And an AI ethicist really drove home the point that these models can be messed with at will.
Which highlights the vulnerability. But the market view is different, not seeing it as a bubble.
Right. Despite the safety worries, the market take seems to be that AI is more of a paradigm shift, not like the dot-com bubble.
Right.
The reasoning is that today's big AI players actually have infrastructure, real products, revenue, unlike many dot-coms back then.
Okay, what about specific company moves in AI from the sources? Anthropic launched Claude 4, Opus 4, good at coding.
Yeah, highlighted as maybe the best coding model, supposedly can work on its own for like 7 hours. And NVIDIA, the chip giant, they're opening up their NVLink Fusion tech. That was a key advantage they had for connecting AI processors. Now others can use it.
Interesting. And Tesla's future was tied strongly to self-driving tech.
Yeah, a Wedbush analyst quoted, thinks most of Tesla's potential stock upside now really hinges on nailing autonomous driving and connecting back to nuclear. AI data centers are explicitly named as a driver for new nuclear power.
Right. You mentioned 3 Mile Island maybe restarting with Microsoft money.
Yeah, and Alphabet, Amazon investing in small reactors, plus the administration orders talking about federal land reactors for AI data centers.
It's wild how AI's computing needs are physically shaping energy plans. The sources also touched on AI bots and information, maybe in a concerning way.
This raises some big questions. Meta, for example. They're moving away from third-party fact-checkers using community moderation instead. At the same time, they're rolling out thousands of AI personas.
Okay.
Critics, even Meta's own oversight board, see this combination as potentially problematic, like a blueprint for subtly steering public opinion. They raise flags about the rollout being rushed, maybe without enough human rights checks.
Yeah, replacing fact checkers while adding AI influencers. Definitely something to keep an eye on. Okay, shifting again. Let's look at markets and the consumer. Your sources started with big oil. What's the situation there?
Well, they had a massive year for shareholder payouts in 2024, record-breaking, actually. $119 billion total. That was like 56% of their cash flow going back to shareholders.
Wow. But analysts are questioning if that's sustainable.
Exactly. There's pressure building. Crude oil prices have dropped over 12% this year so far. And their balance sheets are looking a bit stretched. Rystad Energy is quoted saying, basically, if prices stay low, adjustments have to happen. Buybacks are probably the first thing to get cut.
And we're seeing that already. BP was mentioned.
We are. BP, a European major, already cut his buyback program way back. Their profits fell, cash flow down, debt up in the first quarter. One analyst even called the next 6 months a potential period of maximum weakness for them.
Okay, let's flip to the consumer side. The sources had some data suggesting real financial strain.
Yeah, this really jumped out. The rise in people using buy now, pay later BNPL for groceries.
Or groceries. Seriously.
Seriously, a report cited found 25% of BNPL users are now using it for groceries. That's up from 14% just a year ago.
Using credit for food? That really says something about financial pressure. A consumer divide, maybe?
Absolutely. And the data shows users are taking out more loans and missing payments more often. Over 40% paid late last year, up from 34%. It links right back to food costs soaring. The overall food CPI is up nearly 24% between 2020 and 2024.
And the reasons cited? Supply chain still. Avian flu, Ukraine.
All those, yeah. Lingering supply issues, bird flu hitting poultry, the war in Ukraine messing with grain. And then there's the added worry that another trade war, more tariffs, could push prices for imported food even higher. It's a tough picture for many households.
Your sources also gave a snapshot of the labor market. Kind of a mixed bag.
Very much so. On one hand, you have United Airlines finally reaching a tentative deal with its flight attendants. Big deal, apparently. Like 40% economic gains in year one, back pay, bonus, quality life stuff like scheduling.
And they were the last big U.S. airline to settle with flight attendants, right? So a win for the union there.
It seems like it. But then on the other end, you have the situation for fast food workers detailed in the sources. One report found they need to work almost an hour just to afford the meal they serve.
Wow.
And in some cities, it would take over 70 hours a week just to cover basics like rent and food.
Stark. The sources called it a growing structural disconnect between wages and the cost of living.
Yeah, it highlights that gap. Wages lagging, especially for lower-paid jobs, while costs keep rising. And restaurants often feel squeezed, hesitant about big wage hikes because of thin margins. California's $20 minimum wage was given as an example, leading to price hikes, hour cuts, even closures in some cases. The median wage cited for fast food workers in May 2024 was $14.92 an hour.
Any other market tidbits from the sources?
Just a couple quick ones. GameStop stock rallied again, but analysts tied it more to Bitcoin's moves this time, not really the meme stock thing. And kind of funny, some data suggested novice investors actually did better than the pros in April. Maybe they were less spooked by the tariff talk.
Huh. Maybe beginner's luck or just less fear. Your sources also listed some earnings reports coming up.
Yeah, some big ones next week. NVIDIA, Dell, Costco, Salesforce. That'll give the market more data. Last week, things were pretty quiet after the House tax bill passed. S&P, Dow, NASDAQ mostly flat. Treasury yields dipped a bit, but still high. Oh, and Japan's inflation rate. Still pretty elevated at 3.5% in April.
Okay, let's wrap with some personal finance and investing points you pulled out. That issue with mutual fund taxes.
Ah, yes, the capital gains surprise. This trips people up. If you have regular mutual funds in a normal brokerage account, not an IRA or 401k.
A taxable account.
Right. The fund manager might sell stocks inside the fund during the year for a profit. Then at year end, they distribute those gains to you, the shareholder, and you owe taxes on that distribution, even if you never sold your own shares.
And it's taxed at capital gains rates, which can be up to 20%, plus maybe that 3.8% surcharge.
Exactly. It can be an unexpected tax bill. But the sources mentioned there's a proposed fix.
The Growth Act. And a House bill, what would they do?
Basically change the rule. So instead of paying tax on those internal fund gains each year, you'd only pay tax when you actually sell your shares of the mutual fund, defer the tax.
The idea being to create parity with other investments, encourage long-term holding.
That's the argument. And it would impact a lot of money, something like $7 trillion in those kinds of mutual funds. But, the sources say it's uncertain if these bills will actually pass, especially with the bigger tax bill also in play.
So for now, what can investors do to avoid that surprise tax? Any alternatives mentioned?
Well, one option is switching to ETFs, exchange-traded funds. They're usually structured differently and tend to have much lower or zero capital gains distributions.
But switching itself could trigger tax if the mutual fund went up.
Good point, yes. Selling the mutual fund to buy the ETF could be a taxable event. The other, simpler way is just to hold mutual funds inside tax-advantaged accounts, like your 401k or IRA. Then you don't worry about annual distributions. It all grows tax-deferred.
Makes sense. And there was that very specific rule about investment advisors, 8 words they can't say.
Oh yeah, that was a fun detail. To prevent hype, advisors are specifically barred from using language that gives, like, exact price targets for stocks or makes definite forecasts about future performance when promoting themselves.
Huh. Very precise. Okay, finally, that no tax on tips proposal. What's the story there?
Two versions kicking around. The Senate passed a standalone bill, bipartisan support, and the big House tax bill includes a temporary version.
So what would it actually do?
It creates a federal income tax deduction for cash tips, up to $25,000 a year, but only for tipped workers earning under $160,000 adjusted gross income. The Senate bill is permanent. The House one lasts 4 years.
Okay. What's the cost?
The estimates cited are around $10 billion a year in lost tax revenue. So the temporary House version is maybe $40 billion over a decade. The permanent Senate one could be over $100 billion.
And what do critics say?
The critics quoted call it egregious deficit spending. They argue the economic impact is tiny, negligible really, because it only helps a small slice of the workforce, like 1.7%. And they also point out, because it's a deduction, it doesn't help the roughly 1/3 of tipped workers who already earn too little to owe federal income tax anyway. They have no tax liability to deduct from.
So even for tipped workers, it doesn't benefit everyone.
According to that analysis, correct.
Wow. Okay, that was quite a journey through a lot of different topics, from the details of a tax bill to AI safety levels, global supply chains, how people pay for groceries, even rules for financial advisors.
It really does show how these things are all connected, doesn't it? Policy in Washington impacts tech, impacts markets, impacts your grocery bill, your job, your taxes. You really have to dig into the sources, get past the headlines to see those connections.
Absolutely. And thinking about those connections, maybe here's a final thought to leave everyone with, tying a few threads together. We see these efforts, like using tariffs to try and bring manufacturing back home, but then we see the realities, the complexity of supply chains, like with the iPhone, the immediate pressure on consumers from rising food costs. And overlaid on all that, the very different situations for workers, from airline deals to fast food wages. How do those policy goals really stack up against the pressures and realities on the ground?
Yeah, that tension between the big policy idea and the messy, complex reality, that's always there, isn't it?
A lot to chew on there. Well, thank you again for sharing your sources and walking through this deep dive with us today.
My pleasure. Always interesting.